Welcome back, everybody. In this video, we're going to talk about what a short squeeze is, how they happen, how you can find them before they happen, everything that you need to know to play them like a pro, and the difference between a gamma squeeze and a short squeeze. But first, hit that subscribe button, turn on your notifications, and leave a comment below if you've had any luck playing short squeezes. So what exactly is a short squeeze? In order to understand what a short squeeze is, you first have to know what taking a short position in a stock is. So when an investor takes a short position in a stock, they're essentially betting that the stock is going to decline in price. So what happens is they borrow the shares from their broker, they sell them on the open market, and then they will buy those shares back, hopefully at a lower price, return the shares back to their broker, and then they profit the difference. That's a short position on a stock. Okay, so you get your short squeeze when a stock is overly shorted to the point where a high percentage of the free float is shorted, and then the cost to borrow starts to rise because the shares become more and more in demand. So the cost to borrow those shares starts to increase. The percentage of the float sold short starts to increase. Other investors see that. They'll pile in, hoping to play the squeeze, and then the stock will, as the volume pours in, the price of the stock will start to increase. So then the short sellers will try to buy those shares back at a more expensive price to cover their short position, which further pushes up the price of the stock. All the other short sellers will try to pile in and bail out of their short position, which pushes the price up even higher. And as they're trying to cover their positions, the price is going higher and higher and higher. How do you find the stock before the squeeze actually happens? Well, I'm going to show you. Let's go to the computer right now and I'll walk you through it. All right, guys. So when I'm looking for a stock that I might find interesting, or I'm looking for a squeeze play in particular, the first thing I do is I go to iborrowdesk.com, and it lists from the highest to the lowest the cost to borrow and the shares available to short. So I'll visit this site once or twice a day to take a look. And just for this example, I'm going to use Faraday Future, and we're going to use them as an example because I got their charts pulled up in another window. But anyway, so you'll go to iBorrowDesk and you'll look, and if you see something that you like right now, the highest fee or the highest cost to borrow is GSEI, with 75,000 shares available to short still. But like I said, I'm just going to use this one here as an example. So we'll click on it. And if you scroll down, it'll tell you right here the fee to borrow. So after you look at iBorrowDesk, you click on the ticker that you're interested in. What you'll do is go to Fintel, and I already have this pulled up. And at the very top of the page, it'll tell you the short interest here, the short percentage of the float, which is just about 25%, and your short interest ratio. Now, what your short interest ratio is the number of days that it would take all short sellers to cover their positions based on the average daily volume. So if the volume stayed consistent in FFIE, it would take all the short sellers 4.5 days, a little more than 4.5 days, to cover all their short positions. So then the next thing you want to take a look at is on Fintel the number of available shares to make sure it goes with iBorrowDesk. In this case, it doesn't because iBorrowDesk is lagging. But as of right now, there's 0 shares available to short. Okay, and that's at 4:50 on July 5th, 2022. Scroll down a little bit more, and it'll tell you the cost to borrow. I have FFIE's chart pulled up here just so I can show you. Going from June 17th, okay, the purple at the bottom, that's the volume. I have it color-coded for the volume. So from June 17th, we're looking at, barely, 500,000 trades. It spikes up every once in a while to 500,000, 600,000, but it's all about 500,000, I'd call it. It hits 1 million here once in a while. But anyways, that's not important. If you take a look at the chart here, right, this was being shorted this whole entire time. Okay, the volume was down. We got a little volume spike right here to 10 million. Nothing major happened. The price increased and big red candle, so it was probably reshorted. Then fast forward all the way to July 1st, okay? You could see here by these big green candles that momentum started to pick up. Somebody had realized that it was overly shorted. They started to play it for the squeeze, and they got lucky, or they didn't get lucky. They just did their research and they made a good play. But volume picked up here, okay? July 1st, you probably got some shorts started to cover their shares. They started getting scared. And then you see this morning, they tried to beat it all the way back down, but the volume came in today, okay? And look at the big green candles here. That was a squeeze. That was a nice squeeze play here. But as the day progressed, it slowly got driven back down. So when you're playing a squeeze play, here's what you have to keep in mind, okay? Once the short sellers start to cover their positions like they have here and here, it pushed with the amount of volume that came in today, 31 million at 11 a.m. there was 31 million trades, okay? 12 o'clock there was 20 million. So it had a lot of volume today. But what happens is as the investors pour in to try to play this, they're buying it, it's pushing the price up. The short sellers are scrambling to cover their short positions because on a short position, your losses are infinite. Okay, so if you don't know what you're doing or if you don't have stop losses set up, your losses can be infinite. But so what you want to do essentially is once you get a good, decent profit, you want to bail out because as fast as this spikes up, it'll spike back down because everybody will have their trailing stop losses on, and as it dips down, their trailing stop losses hit and it sells, and it'll dip more, and the next person's will hit and it'll dip more, and it could drop real fast. Now here, I'm not sure if this is going to keep declining. The most important thing that you want to do when playing these is get out before it drops back down. Don't get greedy. You just want to get out with your profit and be happy with it. So now let's take a look and talk about the difference between a short squeeze and a gamma squeeze. So I just explained to you what a short squeeze was, and I'll go over it real quick once again. This was all shorted. The percentage of the float sold short shot up to 25%. The cost to borrow those short shares is currently at 387.1%, which is extremely high. Somebody figured it out, or a group of people figured it out, started to push the price higher. Today, short sellers panicked. They started covering as other investors were piling in to play this play, shot the price all the way up, and it slowly came back down. Okay, so now a gamma squeeze. What exactly is a gamma squeeze? A gamma squeeze is a short squeeze as well as options being covered. So when an options writer sells call options and they're naked, meaning there is no shares to back up those options, they were just using cash to back up their contracts that they wrote. Well, now as that price starts going higher, they start losing money. So now they're scrambling to buy shares to cover their contracts that they had wrote, and now they won't be naked contracts, they'll be covered contracts, and that will push the price up higher. So on a gamma squeeze, you'll have all kinds of investors piling in for the play. You'll have short sellers scrambling to buy shares at a most reasonable price that they could to get out of their short position, and then you have option contract writers that are also trying to buy shares to cover their contracts that they had wrote. So a short squeeze and a gamma squeeze can be highly lucrative if you play them right. But as I had said, once you get in and you make a decent amount of profit, you don't want to be greedy. You want to get out with your profit and walk away, because as fast as they go up, they will come back down because there'll be profit takers on every level, and you don't want to be the last person out. Alright guys, if you found this video useful at all and you got any type of value out of it, hit that subscribe button down below. Leave me a comment, let me know what you thought, and turn on your notifications so you'll be notified as soon as I upload any new content that's designed to help you.